Hello friends, welcome back. In this session, we are going to learn about the purpose of financial reporting. Financial reporting refers to the reporting of income statement, balance sheet and cash flow, or the budget. Why do we need that? Let us understand the purpose and then we will explain to you how to build financial reporting. Why do we need financial reporting? 1. It provides useful information about financial performance and helps us in understanding the current status of the business. That is, whether the business is doing well, worse, or requires any kind of attention, which would affect the long-term growth of the business. This is one of the main reasons why we need financial reporting. 2. We need to know the movement of inflow and outflow. That is, how the funds are moving, whether the funds are moving in the right direction or not, or whether they are making too much of expenditure in one particular section and neglecting another section. All of this information is provided in this section. 3. The next step is to understand financial results. Financial results indicate whether we are making profit or running under loss. In addition, if we are not making a profit, why are we making a loss? And if we are making a loss, how can we improve or take action to convert those losses into income? All of this requires financial reporting. Then, we need the sources of finance and an understanding about the obligations in the business. Basically, we need to find whether the sources are all good or whether we are incurring too many costs in the form of interests or other kinds of costs. We should also understand what is the obligation of the company, whether it is in terms of current liabilities or short or long-term loan obligations. We should understand the company's obligations in terms of tax or any other kind of liability. Finally, financial reporting is useful to make decisions about making investments in the form of capex, buying or selling any of the companies or businesses, or about some kind of financial engineering in terms of investment, which will lead to higher returns, growth and profitability of the company. These are the reasons why we need financial reporting. Now, let us understand the limitations of a financial statement. Again, let me repeat, a financial statement consists of 3 statements. 1. Income statement. 2. Balance sheet. 3. Cash flow statement. We need to understand what the other limitations of financial reporting are. The basic limitation is due to the omission of qualitative information, which indicates all about the financial information. However, it will not provide details about the quality of the team, the brand of the company, or about any issues in terms of direction. This kind of qualitative information is not available. Let us talk about historical basis. But it does not consist of real-time fluctuations. Real-time fluctuations indicate that the financial statement gives information for the last 1 year. However, if something is currently happening, it does not change the previous year data. Basically, it takes into account the real-time impact. The major issue with financial statement is manipulation. We have seen that many companies are manipulated or do not give the actual data, which is based on biasness and affects the quality of and the reliability of the information for the end users. The manipulation is one of the major risks with what the company is saying. Second, it is not compatible when we say that different companies use different methods. The company used standardization, even for recognizing simple items, which will vary from company to company. Furthermore, the items can vary even within the same company from department to department. Let us review how the revenue is recognized or what kind of cost it takes to calculate the profit and how we will charge depreciation. These are various things with a variety of differences, so we should review them to strike a balance and make the best use of these. Usually, this is a challenge because different companies use different methods and it impacts the quality of the information to the end user. Finally, let us discuss intangible assets. The intangible assets are the ones that we either include on the fair value or market value. However, their market value could be very high. Sometimes intangibles may not give the right picture. Again, the items may not reveal the fair value of the goods or items unless we study the intangibles deeply. For example, let us say that you start a business and bought land for $5,000. After 20 years, these $5,000 become $50 million. Your accounts will always show the amount as $5,000. Certain companies revalue the assets and show it as $50 million. There are 2 sets of people. The first set of people will have $5,000 and the other set will have $50 million. There is a lot of discrepancy, which again leads to the same question of standardization. These are the broad limitations of financial statements. However, there are many other limitations as well. In fact, the uses and advantages of financial statement are far more than its limitations, and that's where the importance of financial statement for the analysis emerges. I hope you've enjoyed this session, friends, and I will see you in the next video. Till then, have a nice day and see you soon.